Have you ever wondered why some traders wait for multiple confirmations before entering a trade? That's because no single indicator is accurate all the time. Professional traders often combine indicators to filter out false signals and improve the probability of successful trades. In this strategy, we'll combine the 9 EMA, the 21 EMA, and the MACD. Let's begin with the EMA. EMA stands for Exponential Moving Average. Unlike a simple moving average, the EMA gives more weight to recent price movements, allowing it to react faster to changes in the market. Here, the blue line represents the 9 EMA, which tracks short-term price movement, while the orange line represents the 21 EMA, which reflects the medium-term trend. When the 9 EMA crosses above the 21 EMA, it's called a bullish crossover. This tells us that recent buying pressure has become stronger than the previous trend, and buyers may be taking control. But here's the important part. An EMA crossover alone isn't enough to enter a trade because false breakouts happen quite often. That's why we look at the MACD for confirmation. MACD stands for Moving Average Convergence Divergence. It consists of three components: the MACD line, the signal line, and the histogram. The blue line is the MACD line, the red line is the signal line, and the green and red bars below are called the histogram. For a high probability buy setup, we want three conditions to align. First, the 9 EMA should cross above the 21 EMA. Second, the MACD line should cross above the signal line. This confirms that bullish momentum is increasing. Third, the histogram should be above the zero line and the green bars should continue growing. This indicates that buying momentum is becoming stronger. When all three conditions occur together, the chances of the trend continuing become much higher, making it a stronger buy setup. Now let's discuss the exit. As long as the 9 EMA stays above the 21 EMA and the MACD remains bullish, the trend is generally considered healthy. However, when the 9 EMA crosses below the 21 EMA, it's the first warning that the trend may be reversing. If the MACD line also crosses below the signal line, it confirms that bullish momentum is fading. Finally, when the histogram moves below zero and the red bars continue expanding, it shows that sellers are gaining strength and bearish momentum is increasing. When these signals appear together, it's generally a strong indication to exit the trade and protect your profits. Remember this simple rule. The EMA tells you the direction of the trend. The MACD tells you the strength of the momentum. When both indicators agree with each other, the setup becomes much more reliable than using either one alone. And finally, no strategy wins every trade, so always use a stop loss and proper risk management before entering any position.